Good morning, everyone, and welcome to Multifamily Investor Nation. I'm going to give everyone just a few minutes to join this morning before we get started. Feel free to jump on the chat and tell me where you are tuning in from today. I'll just navigate over there just to see where we have people coming in. We've got a Maryland. It's great. My niece just had a lacrosse tournament in Maryland, actually, and her team got her butt handed to them. They're from Oregon, but it was good for them to face the East Coast lacrosse. Chicago. Where in Chicago, Amani? I'm in the northern suburbs. Great. I love Logan Square. Great restaurants. All right. We are recording and we're up to 20 people so far. So why don't we actually kick in? So for those of you who don't know me, my name is Rob Gallo. I'm the Director of Investor Relations here at PassiveInvesting.com. I have up here on our screen our website, PassiveInvesting.com. You can read a little bit about me as well as our team under the Meet the Team tab. Obviously, while you're there, please check out some of our current offerings so you can see what deals we currently have open for investment. If you want to learn more about what we do at PassiveInvesting.com, you can be sure to click on the Join the Passive Investor Club. That will actually put you on our mailing list. You'll receive all of our education pieces, as well as any new offerings that we have out. So with that said, I want to kick in to our presentation today with the topic at hand. So the topic that I want to talk to you today is about raising capital in uncertain times. This is a very hot topic. I think with a lot of people that I chat with, obviously from an investor relations perspective, but really just across syndicators and operators that are currently in the business, there's a lot of questions, I think, even being asked. I mean, I sit with a masterclass of other investor relations directors. And this is kind of a topic that we talk about quite a bit and share kind of, I don't want to say war stories, if you will, but really kind of tips and tricks that we talk through on that. So what we're going to do today is we're going to go through, talk about kind of what the uncertainty in the markets are. I want to give you a little bit of flavor about what I hear from investors. And a key piece is that it's not necessarily just what's impacting the properties that we have, but it's really impacting the psyche of the investor. And so you really have to think through some of those pieces a little bit. And it's obviously times are not like what they used to be. And you need to be a little bit more prepared. Next thing, I'll just hit on the investor triad. I can't do an investor relations webinar without talking about the investor triad that we really preach a lot, not only to our internal team, but really as we share with other investors and things like that. But really then it bakes into the considerations about raising capital in certain times. So I'll go through a couple of the considerations that we think through and have to be prepared for when we're actually raising capital in uncertain times. And then we'll wrap up with questions at the end. So if you do have any questions, please put them in the chat. I might not get to them during the actual webinar of these pieces, but I will answer them at the end of the session. So a little bit background about me. I'm 41. I live in the northern suburbs of Chicago called Lake Bluff. I haven't always been in real estate private equity. I spent the first 18 years of my career in consulting. I was a healthcare technology and financial consultant for that time period. I really enjoyed it. It really kind of defined me, who I was, but it wasn't necessarily what I wanted to do when I grew up. The great news is that I had an employee that worked for me on two two different projects. And his name was Danny Randazzo. And so Danny Randazzo, as you may know, is one of our managing partners at passiveinvesting.com. And since 2008, when we first met, we have always been talking about how to achieve multiple streams of income, how to do that through passive investing, how to secure our children's college funds through real estate. And, lo and behold, probably year 4 of us working together, he made the decision to jump and go full-time into real estate. And after that many years, he joined up with Dan and Brandon Abbott at the time and created passiveinvesting.com. I myself have been an active and passive investor for 12 years. I work with some family on some Airbnbs, kind of in the New Buffalo area of Michigan. And I've also been probably one of the first investors, well, definitely with Danny on some flips that he did, but also with passiveinvesting.com. So I have been watching, challenging, and working with passiveinvesting.com before it existed. Early last year, I made the jump from consulting into director of investor relations from that point. I have a wonderful family. You can see that picture right here. That's actually a picture of us on a trip and traveling, which is one of the key pieces that we love to do. My beautiful wife, Ashley, my son, Hayden, who's 9, and my daughter, Sienna, who's in the cast right there. And one of the fun things that you never want to do when traveling on vacation is, let's say, have a broken limb and have to go to the hospital, but all worked out. And that was towards the end of our trip. So I like to see smiles on the faces. So let's get into the main pieces here in terms of our topic. So what's going on in the market right now? And this is a lot of this stuff that you're going to see here is really, yeah, of course, Rob, that's what's going on in the market. But how is it impacting discussions? How is it impacting what people actually want to invest in? And what are the typical questions that they're asking because of that? So first one here is, and I'll bring up the second one here. This is a no-brainer, right? We've been dealing with high interest rates for some time now. And really, it wasn't necessarily that they're high. I think it was more to the effect that in that 2000, end of 2021, going really into 2022, inflation started to hit and interest rates really got ratcheted up at a very high pace, which really impacted a lot of properties out there that had floating rate debt on those markets. And so not only impacting the floating rate debt and possibly interest rate caps and what you were buying there, but also cap rates in the market. So a lot of things have occurred because of the interest rates, because of inflation. And then specifically on inflation, any value add projects that you've seen being added, it's not only impacting the interest rates and what the Fed is thinking, but it's impacting the cost of materials. And I think in terms of pro formas that you saw that were done in 2021, they did not anticipate that the cost of materials were going to go up so much. Yes, we had hit COVID, but then inflation actually kicked up too. So there's a lot of pieces in there that kind of put properties in some difficult times. And these are things that investors really want to know about. That how are you handling interest rates? How are you handling inflation? Another piece that really has come up are wars. Now, this might not have a direct impact on your property, but it's definitely impacting the psyche of your investors. So the war in Ukraine, the war in Israel, I feel like we're always at war from being hacked and things like that. But like, what is China doing with Taiwan? What's North Korea doing? So it's not necessarily that these things are impacting the properties right now, but it's definitely an impact on the psyche of the investors. So don't be surprised that when you're raising capital in these times right now, that things are going to come up like that. And they're going to ask, well, how's that impact us? So I'm going to hold on that question. But I want you to make sure that it's not necessarily just the direct things that are impacting the properties, but other things that really, from an investor perspective, are hitting it. Obviously, recession, that's a big one that has come up. A lot of people are saying, hey, there could be a recession in a month, or there could be a recession in a couple of years. I think the data is, kind of mixed on that, depending on what key metric that you're following. I know, the yield curve was this huge thing about having an inverted yield curve, and that predicted, the last 9 or however many recessions. Well, if you've been following the yield curve for the past like 4 years, that thing has been inverted I don't know how many times. And so now you're getting people saying, well, not the yield curve, it's this metric. So just make sure that, when you're talking to investors, that you're prepared to actually speak to recessions and what you might do. Obviously, the next big thing that's happening in the US right now are elections. So we've got, Trump and Biden going at it for the presidential candidacy, or excuse me, not the candidacy, but the presidential being president. So there are those impacts there that you really have to make sure that you kind of understand what's going to happen if, let's say, Trump wins versus, let's say, if Biden wins. Another big thing that we're facing right now is weather, and this is a direct impact as well as an indirect impact. So obviously there are direct impacts like hurricanes. Obviously, Texas just got hit with another hurricane, and we're, I guess, on record to hit another extreme hurricane season. But that'll obviously kind of work itself out into whether or not that actually occurs or not. But that impacts taxes, that impacts insurance, that impacts cash reserves. Because if you have a hotel, or excuse me, if you have a piece of property along the coast or that is in basically one of those ranges, you need to make sure that you're bolstering some of those cash reserves, because there could be damage that isn't completely covered by insurance. So a lot of those pieces need to be factored in. I'm putting this next one on here because this was a question that came in before the 4th of July, terrorist attacks. Now, I'm not saying that there is a terrorist attack or anything like that coming, but we had an investor write in and say, I have under good knowledge that there's going to be a terrorist attack around the 4th of July. And what are we doing to make sure that, some of these loans can't change? Now, it's on here not necessarily because it's a terrorist attack. What I'm saying here is, again, it's that psyche that we really have to understand from our investors and be able to translate into, making sure that they understand, okay, if something happens, like maybe we don't have insurance against a terrorist attack specifically, but here are the things that, are in with the loan agreement. Here are the things with our insurance that we have, just to make sure that they're fully aware that, yes, we have that covered. I've talked about insurance a little bit. That's really kind of that indirect coverage or direct coverage from weather and a bunch of other things. But as you've probably seen in the insurance market, that rates have skyrocketed. Interestingly enough, I was at a conference in the spring, and it was a conference that had a lot of insurance companies as well as brokers and so on and so forth. And really, the insurance people were saying, this is not out of the blue. Like, we have kept rates so low to win business that we've actually been, hamstringing ourselves in order to actually run our business. And so how they see it is that actually now insurance premiums are coming up to par. Not necessarily that everyone's going crazy and getting more and more expensive just on a whim. It's actually coming up to where they actually can cover replacement costs. So I know people are very upset about what's going on with insurance. But if you look at it from the insurance side, they're saying, no, this is actually where we need to be at in order to replace these homes that are in properties that are being damaged. And obviously, taxes is one that's always going to be there. There's going to be new tax assessments that are happening, and you need to make sure that you've got plans in place to handle, when those taxes come up. So this is just a smattering of pieces that really are uncertainty in the market and the things that we are hearing. So it's important to make sure that you consider these things when we go about that. I did see one thing about alien invasions that is funny, but you'd be surprised how many people ask weird questions. We love our investors, and they're very interesting and very successful, but they ask some very interesting questions. Bottom line is, make sure that you're prepared when you go into these. Maybe not for alien invasions. I don't think there's going to be an insurance policy on that. But that you take kind of the top 5 or top 6 things that could happen that could have a direct impact or indirect impact. So again, like I said, I can't have one of these presentations without talking about our investor triad. This is the know, like, trust triad. The first piece on here I'm going to talk through is just really the traditional approach that we have. And then I want to talk a little bit about how we really utilize this. So first and foremost, you have to have an investor that knows who you are. They have to know who passiveinvesting.com is, what you guys stand for, what you do, what your returns are. That is the most important step, because until they know you, you're not really going to be able to make that development of development of that relationship to where they can like you. This is where you start talking about, well, what are you really interested in? Getting to know the investor. What makes them tick? What are they looking for in an investment? And kind of starting to talk through those pieces to really develop that relationship, but also understand what offerings might make sense for this person. Once you have that, then you start to develop that trust aspect, right? So this is, hey, I'm only going to bring you offerings that I know that align with you. I'm not going to hammer you with, a bunch of debt funds if the most important thing to you is depreciation, right? It's about then building those pieces and really establishing that trust. Even like, hey, I'm going to get you into one deal, and I'm not going to push you for that big investment at first, but why don't you get in, get a taste, understand how it works, start to build that momentum, see returns come into you, and then that really starts to create that track record of trust. Then that trust then comes back into the know really through referrals. So that is the traditional aspect that we look at this. When I look at this now, it's making sure that, hey, from an investor relations side, I want to make sure that I know the investor, right? Now, maybe not like the investor, but it really have a respect for what that investor wants to achieve, right? Build that relationship to understand what they're interested versus what they're not, and then bolster that trust with them by being consistent with messaging, by being clear, concise, answering emails, answering phone calls, being present. You really have to kind of think about it. Yes, this is what we are looking for, the journey that the investors are on, but how at each one of these points do we as investor relations people to raise capital are interacting with them? So this is kind of a good setup into kind of the key considerations that we have when we're raising capital in uncertain times. This is by no means a complete list, but these are kind of the top pieces that when I sit down with my investor relations team, when I talk to Dan Handford about this, these are some key pieces that we continue to harp on. And are we 110% on these every single day? No, but we want to make sure that this is where we want to get to. So a couple of the things in here that we can talk about. So first thing is build those relationships. We just talked about the investor triad. You have to spend time with your investors to build those relationships, because if you don't do that, and you're just basically screening people and saying like, oh, well, you don't count, or, it's too much time talking to you, so on and so forth, you're never truly going to understand what your investor wants. And that's kind of the key critical piece here. I've talked to a lot of investors in terms of really what they want to invest in, what they're looking for. That helps me understand that, hey, when a certain investment property comes up, am I going to send it to them as like a VIP, or I'm going to say, you know what, I know this isn't something you're interested in, and I'm going to weigh back on that. Sometimes to those investors, that conversation about, hey, Rob, I appreciate you sending me things that I'm interested in, and knowing that you also hold back when something comes up that I'm not interested in. Now, I'm not saying that that is for everyone, but that's some of the feedback that you get when you truly understand what your investor wants. The next piece is, and this is a little difficult right now because it's aligning offerings to what investors want. So not everyone can do this, right? If you are a multifamily and you only focus on multifamily properties, great. That's perfect. You focus on that. But that's not maybe what the investors want right now. As we've gone through these higher interest rates, high inflation, insurance, and things like that, I think we all know that multifamily right now is not necessarily at its peak. You have a lot of floating rate debt loans on some of these properties that either coming due, or really it's the cap rates that they had need to be extended, and so there's additional capital that needs to come into those, as well as possibly some loan paid out. This can equate into capital calls and a bunch of other things. A lot of investors right now are not necessarily overly eager to jump into a multifamily right now, and so you have to understand, are the products that I'm offering right now what investors want? Is the deal good enough in terms of getting it over that hump to say, okay, I understand I've got all these projections here, cash on cash and IRR, but how are you making sure that I'm going to achieve that? And what are the things in place or lessons learned that you have that you can equate to that? So it's kind of biparted there, and we'll go into the second piece there, the bifurcation. But really making sure that the offerings, and when you're talking to your investors, try to understand what offerings that they want to invest in now. If they say, hey, guess what? I invested all these things in these properties because I needed cash flow. Depreciation's great, but I need cash flow. Maybe another multifamily isn't necessarily up their alley. Maybe you want to steer them to a debt fund of some kind. For example, we've had, we have 16 multifamilies. We are selling a few right now. But instead of necessarily like looking at a pure multifamily play, we created a promissory note on one of our multifamilies that accrues a 10% and 12% interest rate on that. It is 2 years, but it's really kind of saying like, okay, how can we be more secure? Yes, it's still multifamily, but how can we secure it more that it's directly after the loan in terms of the capital stack? And you're not necessarily going to be as impacted that if, okay, maybe when we sell, we only got, just a 1.0 equity multiple, or God forbid, a 0.9 equity multiple. That accrual and that loan will get paid back to you because of where you are in the capital stack, versus, hey, I'm class B investor that I get a smaller preferred return, but a higher upside if we sell at a larger number. So it's being able to kind of understand that and be flexible with what the investors want, as well as what the offerings that you're providing out there. Next thing, that when you're bringing a property to the market, whatever it might be, please be realistic on the raise. And this is actually existing investors as well as bringing in new investors. Being here right now, July of 2024, is a lot different than July of 2023. And that's a lot different than July of 2022 and 2021. I think in 2021 and 2022, like, we couldn't bring enough properties to the market because people wanted to invest. And it was relatively easy times in terms of raising capital. Now we're sitting here in 2024. We've just gone through all those uncertainties. We know where we are with multifamily. We know where we are with interest rates. It is not as easy to raise capital. So if you're putting together your raise plan for a new property that's coming out, make sure that you're taking into consideration, hey, it's going to be harder. Those things that we used to do with, let's just do a podcast, let's send out an email, the money's going to come in. You're going to have to basically work twice as hard, and sometimes even 3 times as hard, to actually get to that same amount that you're going to be doing. And so you're going to have to change some of your approaches to expand that funnel and be able to bring in new investors as well as talking to existing investors. The next piece on here is plan for those risks and uncertainties. So just like we talked about before, there's a lot of those uncertainty pieces. You need to make sure that you have a plan in place that is logical for the majority of those high-level risks. Now, again, I'm not talking about alien invasions, right? But what I'm talking about is, okay, if inflation continues to go up, how have you actually done your underwriting that you can actually still meet a cash and cash return with increased interest rates? What happens if we go into a recession? Are you placed in an appropriate market that is, quote unquote, recession proof? and maybe not, you can't say that specifically, but what's happening in that market that's going to be able to help you continue to drive those rents? Are there stable businesses in that market that are growing or expanding? Or maybe they're really impacted by what happens in the market. So if you think about all the uncertainties that an investor thinks through before they actually make an investment, make sure that as part of your plan in raising capital, that you're thinking through each one of those. And please don't say, well, real estate goes up. Boom, that happens. Yes, on the aggregate, if you look over time, real estate has appreciated, but we're in these cycles, and be them 10-year cycles or 6-year cycles or 7-year cycles, whatever they may be, you're going to have these ups and downs like we're experiencing right now. And you need to make sure that you can plan and plan for the risks that, are going to occur, as well as minimize those ones that, in reality that you just can't control. Next piece on here, be transparent and honest every time. And I'll probably a broken record on this. When you're raising capital in certain times, you have to be even more transparent and honest. If you had a capital call, there's no shame in saying that. If you don't inform people that you had a capital call and they find out you had a capital call, that investor is not going to invest with you, probably ever. Being upfront about things that have happened to you or in the past, or what what's coming down the pipe, is incredibly disarming for an investor. It's like coming in saying, like, you know what, I was wrong. This is what happened. I misspoke, or we made some wrong assumptions, but here's what we're doing to change that. So basically saying, be honest about what has occurred in the past, be transparent about it, own up to it, but be able to share those key pieces of lessons learned. What is now different from those initial deals that maybe didn't go so well, that now you're taking and changing and preparing for the future? It is an incredible tool that, again, everyone wants to come off as shiny and knowing everything and being super smart. But it's amazing the reaction that you get when you're talking to investors and you say, you know what, we were wrong with that assumption. We were wrong with those 3 assumptions. But here's what we're doing now that are building into our performance and how we're working with insurance companies, the developers, so on and so forth, to make sure that we don't do that again. That is a critical step to either keeping investors or at least making sure that they're not going to just back away from you forever, and that maybe they're going to come back in that next cycle. Last piece that I wanted to share is communication. And I really kind of break these up into 2 different, the inbound and the outbound. So for inbound communication, as investor relations, you have to make sure that your response time matters, as well as your accuracy. And when I talk about response time, so we try to stick to about an hour within working business hours. We try to stick to an hour or less in terms of responding to our investors. Now, we might not be able to answer the question right off the bat, but having a response, knowing that an investor is reaching out via email, text message, phone call, whatever that might be, knowing that there's someone on the other end saying, I received your message. I'm going to follow up with the team and I'm going to get back to you. That's very important. The next piece is accuracy. Investors hate it when you say one thing and then you come back and turn around and you say another thing. Make sure that accuracy is extremely important, okay? I've been on the end where I've actually mistyped or missaid something, and I get back to them and I say, I completely apologize. Here's what it is. I wish I could have gone back and made that more accurate, right? But it does matter, obviously. And then the last piece I'll say about that, it is okay to admit, like we talked about, admit that you're wrong and basically make sure it's corrected. But accuracy does matter, because that inaccuracy does lead to more frustration. Now, on the outbound side, clear, timely, and effective. You don't know how many drafts we go through when we're actually developing either monthly communications or, specifically announcing new deals, or how we're communicating with our investors. But the point is that we want to make sure it's clear and effective, that we're not necessarily hitting them with, oh, here's, 18 paragraphs about what you should be concerned about or what you should know about this property. We want it to be very clear so no one's confused, and obviously effective. So we're hitting, hey, just read these 3 things, or these 3 paragraphs are going to give you all the information that you need. That is also appropriate. The last piece here on the outbound, you need to be timely. I'm saying this because there's a lot of organizations out there that will hit someone, boom, 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 like, hey, I'm going to send you 4 emails a day, or I'm going to hit you this, this, and that. That is a very, very good way to get blocked. And specifically blocked with current investors that actually need monthly updates, because then they say, well, where's the monthly update? They're like, well, you actually unsubscribed. Well, I didn't know I did that, so on and so forth. The reason they're doing that is that you want to make sure that they are timely in terms of this is impactful for these specific reasons. So these are some of the considerations that we really think about specifically now in these uncertain times. And what I'd like to do now is pause. If you have any questions, please type them in the chat, and I'll answer them. So let's see. Question came in, are these tips more so leaning to retail investors or across the board to include multifamily or family offices, so on and so forth? So yes, specifically these are geared to the retail investors. However, you can take these and extrapolate them onto multifamily, or excuse me, family offices. So obviously family offices, depending on the sophistication of that family office, you could extrapolate some of these pieces to say, like, well, make sure that your financials are clearly articulated, that your contracts with them, that your NDAs, all of those other pieces that then you have to go and do with family offices are there. Again, depending on the sophistication of that family office, they could honestly think like a retail investor, or they could be more of a, very sophisticated retail investor or family office that needs more information, wants more control, so on and so forth. But really, these foundations really stay the same. Okay, let's see if we have any other questions that have come in while we've been talking on that one. It doesn't appear to be the case. So let me just, from a wrap-up perspective, first and foremost, thank you so much for everyone. If you have any additional questions for me about raising capital, you can reach me at rob@passiveinvesting.com. It's pretty easy and simplistic, or you can reach out to any of our investor relations associates at investorrelations@passiveinvesting.com. Just a few plugs here. If you haven't already, we have created a apartment syndication book that's out on shelves right now. So please make sure that you see that. And if you have any additional questions about what our next upcoming webinar is, you can visit Multifamily Investor Nation. I do have someone that has raised their hand. Guillermo, do you have any other questions there? Question came in about what platforms do you recommend to raise capital for the lame investor? Good question. So one of the key pieces here that when we say create platforms, and I know this is probably in another couple webinars that we have, you really want to focus on when you're starting to invest. What's your focus on the avatar? Who are you trying to invest with? So for example, one of our avatars that we really try to focus are physicians, and not only physicians, but really medical, persons that work in the medical industry. And so you need to make sure that, okay, from that perspective, what are they paying attention to? What are they looking for? How much time do they have to watch podcasts or webinars? Or is it more, hey, when they go to one of their medical conferences, maybe we can piggyback in there to say, hey, you're a busy physician, you really have no time on your hands. Let us kind of teach you quickly what you should be thinking about outside of, let's say, like a 401k or any profit sharing plans that you're having, so that you can start building that passive income. So when we do that, we try to specifically work on medical. We want to make sure things are easily digestible, that they're quick. We did a medical series, I think at the end of last year. All of the sessions we tried to keep under 20 minutes so that it was very quick. We also wanted to make sure that there were like people that were actually talking to them, so that we had physicians that actually have raised capital, so they could speak to them about the issues that they're facing. Because a lot of the issues, it's not necessarily about, in terms of relating to people, it's not necessarily just about, yep, we've got this great opportunity and returns and results. It's about understanding, hey, I went to medical school thinking this, I got out, it's not necessarily what I thought it was going to be. And now I'm having these issues, and now I don't really understand how I'm going to reach the goals, let alone pay back, any debt that I have. It's about making sure that you have someone that can understand that, and then be able to kind of turn that conversation into, okay, well, where do you want to be? What do you want to achieve, kind of thing. And let's see, we've got maybe one or more questions. Okay, that's it. Well, again, thank you, everyone. It's been a pleasure, and I hope to see you in the next webinar. Last one that came in. Marlon, what's your team's average outreach contact goal per day? So it's 25 phone calls. And then we'd like to get up to 40 overall contacts per day per person. Thank you, everyone. Have a great day.